Hello, welcome to our video, the 3 ways staying in the market, trying to get back to what you've lost. Could make you work longer, could maybe make you reduce your retirement lifestyle, and could help you outlive your money. And probably more importantly, if you stick around for this entire video, we're going to share what might be a better way for you. Kurt Jackson here with KJ Financial. Thanks for joining us. You know, recently, one of the biggest concerns of retirement savers have, and the question that they're asking themselves is, will the current market ups and downs negatively impact my retirement? So is there any chance that you've also been asking yourself any of these 4 questions in the past year or more? Number 1, will these market losses mean I'll have to work longer? Number 2, will these market losses mean I'll have to work in retirement? Number 3, will these market losses mean I'll have to cut back on my lifestyle in retirement? Number 4, will these market losses mean I may outlive my money? So aren't all these extremely concerning questions for any current or soon-to-be retiree? Look, hopefully our video is going to help you understand what you need to be doing to avoid all these outcomes for your retirement. So let's dive in with number 1 of our 3 ways staying in the market to get back what you've lost could be a huge mistake. Number 1 is stop losing money. Look, I don't care what you've been told about losing money. It's never okay to lose money. Losses are way too costly. And as you watch today's video, hopefully you'll see why we believe that. So did you realize the general stock market has had only one losing year in the last dozen years? Yeah, that was back in 2018. That was the only down year for the Dow Jones and the S&P 500 since the Great Recession back in 2008. Now, from the looks of things, 2022 could be another down year. No, that all sounds good, but here's the crazy thing. Just one down year in 30 years can cost you big. What do I mean by that? Well, let's say hypothetically, let's assume you have $100,000, you invest it, and let's say you earn 10% per year for 30 years. Look, we know that's optimistic, but it makes the math easier to understand. Look, at that rate, your investment would have grown to about 1.7 million over that 30 years. Now, if in just one of those years you lose 10%, even if you earn 10% all the other 29 years, your investment only would grow to 1.4 million. That's $300,000 less. You see what I mean? So when you think about it, does it even make sense that you have to lose money in the market to be able to make money? Because isn't that what we've always been taught? Maybe you've been led to believe you shouldn't sell out of the market when it's down because you're just locking in your losses. Now think about that. If that was true, wouldn't we also be told to sell when the market is up so we could lock in our gains? Has anyone ever told you to do that? So haven't you either lost or gained the money whether you sell or not? Now, is it any wonder why someone who makes money by having your money invested in the market would want you to keep your money in the market, right? A shock. What many don't understand is when you lose money, it takes a higher return than what you lost to get back to even. And making matters worse, the more you lose, the needed return to get back to even grows exponentially. See, when you lose 10%, you need 11% to get back to where you were. You lose 20%, you need 25% to get back to where you were. If you lose 50%, you need 100% return to get back to where you were. And if you lose 80%, you need a 400% return to get back to where you were. So do you see how the amount it takes to get back to where you were grows exponentially the bigger the losses get? Now, you're probably thinking, all right, Kurt, if I get out, where do I put my money, right? Well, sit tight, because as I said earlier, we're going to share a potential alternative in just a bit. So number 1, all right, is stop losing money. Well, what's number 2? Pay attention to fees, to the fees that you're paying. Have you ever heard this? Oh, fees are just a small sliver of the pie. They're around 1%. Has anyone told you that fees for managed money typically averages around 2.2%? So the biggest question here is, has anyone ever extrapolated the impact of fees on your ability to build wealth over time? I would seriously bet that nobody ever has. Well, we're fixing to do that. Do you think the impact of fees on your ability to build wealth is small, medium, or large? I hope I didn't give away the answer with my last sentence. So here's a hypothetical example based on putting $100,000 in the S&P 500, including dividends, from the beginning of 1998 through October 12, 2022. That's the date. October 12, 2022 is the date we put this info together. This is a good sequence of return. We consider that because we start out with 2 really good years. You can see that in the left column, the left green column, before we suffer any losses. Right. Now, always remember, historical returns do not predict future returns. We chose this time frame because it has some really good times and some pretty low times. And we feel that shouldn't that be what we're planning to possibly happen for us in retirement? All right, well, the average return for the S&P 500 for this almost 25-year time frame was 7.07. The average return for dividends was 1.83. That's given us a total average return of 8.9%. Now, isn't average return what they advertise to us when they talk about market investments? So they would say, oh, over the last 25 years, we've done the market, the S&P 500 with dividends has done 8.9%. Now, if you were told you were going to get an 8.9% average return over that period of time, if you ran an online calculator, you would think you would have ended up with $842,700 and almost $47. So there's a problem here. Okay, average return is the sum of all the returns divided by the number of years. It's really more of a math term, not a money term. Because when we put money to the equation, we start to see a lot of inefficiencies. The market isn't up 8.9% every year with dividends. In fact, over this 25-year period, there were exactly 0 times the market was up at 8.9% with dividends in a given year. So remember, higher returns are needed to get back to where you were after a loss, and we suffered some significant losses during this time frame. Do you think those market ups and downs could add more inefficiency to your ability to build wealth? Would you like to see some proof? All right, well, when we put money to this, the actual return drops to 7.44%, and our ending balance goes from 842,747 to 601,253. That is $241,494 less. That's 28.66% lower. So is that a little or a lot of inefficiencies? I don't know. Maybe losing $241,494 in wealth is not a big deal to you. But hold on, what haven't we included yet? Fees, right? So let's assume fees are 1.5%. And I know we're typically told fees are around that 1%. So our research has showed managed money averages about 2.2% in fees. So we picked a number somewhere in that mid-range. So if we add up almost 25 years of fees, I almost gave it away there real quick, didn't I? You'd have paid $76,132.55. Okay, so not terrible, but also not great. So what do you think your ending balance would have been after this almost 25-year period if our actual return gave us $601,253 without fees, and fees were $76,133? Would it be reasonable to assume that you'd have $525,120 after subtracting the $76,133 from the $601,253? I think that's what a lot of people think. So it's not that big a deal. But here's the thing. Do you think fees, when it comes to your balance and everything, do you think the fees act reasonably? See, one of the biggest advantages of investments is the power of compounding interest. But aren't fees just guaranteed annual losses? You got to pay those every year, right? Do you think compounding could go the other way when you're suffering losses? Could those guaranteed annual losses that fees create, could those losses compound? So could those fees compound your loss of wealth? So would it be a big surprise or a little surprise to find out after fees, your ending balance in this hypothetical situation would be down to $390,789? So your actual return after fees was 5.6%. Not the 8.9% average return that was advertised or the 7.44% actual return before fees. So isn't 5.6% a long way from the average return of 8.9? So just how inefficient are market investments when you look at having inconsistent returns, mix in some losing years, and the compounding losses caused by fees? See, we didn't get $842,747 like we thought we would have with that advertised 8.9% average return. We didn't even get the 7.44% actual return because it dropped our balance $241,494 to $601,253. Then our $76,133 in fees, that small sliver, left us with an ending balance of $390,789. That is a full $451,958 less than we initially thought we would have with that advertised rate. That's a whopping 53.63% less wealth. So is that a small amount of inefficiency, or is that an enormous amount of inefficiency? And that's in a good sequence of returns, what we would consider to be a really good market. Well, what would the impact be if we had a bad sequence of returns? So let's change it up a little bit. We're going to start at the beginning of 2000 through that same October 12, 2022, once again, that's just when we did the calculations on this, hypothetically invest in $100,000 in the S&P 500, including dividends and 1.5% fees. So if you'll notice here, the first 3 years suffer sizable losses. That was the dot-com crash, making this a bad sequence of returns. Now, the average return in the S&P 500 was 5.68%, plus 1.84% average return in the dividends. That gives us a 7.52% average return over this almost 23-year period. Now, look, that's not a bad advertised rate considering you got 2 recessions and another almost 25% loss in 2012 through October 12th. Is it any wonder people think that they can easily build wealth in the markets if they just stay the course? Now, if you had run an online calculator with $100,000 for almost 23 years, getting a 7.52% average return, you'd have expected to have $529,972, right? Now, from what you've learned so far, do you think that's the actual return you would receive? See, when we put money to it, the actual return was 5.46. The actual balance would have been $339,994. Isn't that $189,978 lower, 35.85% less? Now, here, take a note. Did you notice in a bad sequence of returns, the power of losses was a little more powerful? See, we didn't have those 2 good years to help offset that. Didn't we lose 28.66% in that good sequence, and now we've lost 35.85%? So maybe avoiding losses in a bad sequence of returns is even more important. The fees over almost 23 years were $47,573. I guess one good thing about having less money is there's less fees, right? Sorry, I was trying to find a little ray of sunshine there. Not knowing what you know now, would you'd have likely thought your ending balance should have been $292,421 after fees, right? But remember, guaranteed annual losses of fees compound, right? So your actual ending balance after fees was down to $260,079. That's an actual return of 4.24%. Okay. Haven't we gone from thinking we'd have $529,972 down to $260,079? Are you seeing how devastating that? Isn't that a loss of wealth that you thought you would have of $269,893? That's 50.93% less. So are you seeing how devastating losses and fees are in destroying your ability to build wealth? Now you're probably thinking, oh, fine, Kurt, you're beating us up here. Is there anything we can do about those losses and fees? Well, let's look at number 3 in our 3 ways. What if we could lock in gains while protecting all the money that we already have? Wouldn't that eliminate one of our 2 major issues left? So what if you could never lose money that you have and lock in gains along the way? So if you could never lose money when the market's down, yet grab gains when the gains are available, would that be almost the best of both worlds? So has anyone told you that this type of financial vehicle exists? Would you be surprised to know that they've been available for more than 20 years? So one problem is that we still have those fees in the equation, right? Well, how about we dive into a possible alternative to see if we can't handle those pesky fees too? Okay, so if you have something that protects you from losses, it isn't always going to give you all the gains, right? So, because doesn't there have to be some give and take there? So let me share a quick strategy, just looking at it from a 30,000-foot view. Look, I'm not going to go to all the details here. We don't have time. I just want to give you an idea what it might look like. But if you want to know more, I'd be happy to go over all the details with you in a virtual call at a later time. Look, our first example is linked to the S&P 500. Okay? It's not in the market. It's linked to the market. So we do not lose money when the market is down. It also credits up to 13% of the S&P 500 without dividends. Yep, make sure you understand that, without dividends. Then it locks in any gains and all the money that you already had in them on an annual basis. And get this, it has no fees, right? No, there's costs involved, but they're essentially baked into the cake, so to speak, right? They're built into the financial vehicle, to the design of it. So if the company that created the financial vehicle didn't need costs to operate and need to make some profit to stay in business, then maybe the crediting rate would have been higher. Okay? But the fee is not dragging your balance down each year. You're not getting compounding losses because you're having that guaranteed loss every year due to fees. Do you follow? All right, so that 13% cap means this. If the S&P 500 were up 15% without dividends, you get credited with 13%. and that's locked in annually. It would have been locked in on an annual basis. If it was up 5% without dividends, you would get 5%. If it's down 20% without dividends, you wouldn't lose a penny. Zero's your hero. Powerful stuff, isn't it? Does that make sense to you? How about we look at a hypothetical example using our good sequence of returns from the beginning of 98 through October 12th of 2022. Now recall, our actual ending balance in the market after fees in this scenario was $390,789. Now, our alternative is linked to the S&P 500, but it's not in the market and it does not get any dividends. It can grab gains up to 13% and lock them in on an annual basis. There are no losses ever when the market is down, and there are no fees dragging down your wealth, and we certainly aren't getting any compounding of those fees. So in that same good sequence of returns, your ending balance would have been $613,485. That's an actual return of 7.53, which is $222,695 higher. That's 57% more than the market model with fees. And remember, this was a good sequence of returns, so that's a better performing market. So it did a really good job in a good market. Now, in our bad sequence of returns from the beginning of 2000 through October 12, 2022, remember our actual ending balance after fees was $260,079 at 4.24% actual return. Remember, our alternative is linked to the S&P 500, but is not in the market and no dividends, grabs up to 13% in gains, locks them in annually, no losses ever, and no fees dragging down your wealth. Certainly no compounding losses, compounding of losses either. Our ending balance in this scenario, this hypothetical scenario, would have been $480,449. That's an actual return of 7.06. And $220,370 higher. That's 84.47% more. Now keep this in mind. Our average return, remember in this scenario, was 7.52%. Our actual return is 7.06. Do you notice how the difference between them has gotten much smaller? So let me ask you this. Isn't avoiding losses, grabbing and locking in those gains, and no fees, isn't that a much more efficient way to build and protect your wealth than relying on the market with its risk of loss and enormous fee drag? So even in a bad sequence of returns, didn't safe and productive growth considerably outperform the market model with fees? So which of these two situations would you have rather been in during the good sequence of returns? And which of these two situations would you have rather been in during the bad sequence? Would this be a good place to move money right now when the market is so volatile? Would it be a good place to have your money all the time, right? Would it be a good place to have your money protected from any future losses while still proving to be a good place to not only find growth, but also to protect and lock in those gains? Do you still believe that you have to be in the market in order to recoup your losses? Do you believe having your money in the market is the best way for you to build and keep wealth going forward? Or could safe and productive growth be the best answer for that retirement money that you're currently losing sleep over because of the potentially losing more money? My name's Kurt Jackson with KJ Financial. We specialize in helping people put together safe and productive growth strategies to help take volatility and market losses, which increases the uncertainty of your retirement years, out of the picture for you. So here's my next question. Is it a priority for you to make market ups and downs work to your advantage, or are you perfectly fine to continue having it hurt you? Would you be open to exploring what protect and growth strategies might look like for you and your family? So if this is a priority and you would be open, go ahead and click the link that's below the video to get yourself on my calendar, or go to bookkurtnow.com. Get on my calendar so you can schedule your safe and productive growth strategy consultation. Look, we're not going to sell you anything. We're just going to uncover your retirement concerns. We're going to see if what we do would be a good fit or not with what you need and want with your retirement money. If you feel it is a good fit, great. And you want to do something with us, even better. If you find that it's not a good fit, at least you've done your homework on it. So really hope to speak with you soon. Thanks for tuning in.